Before we start our today's lecture, check out our 7-Figure Traders program, a program dedicated for you to become a high-performance trader, only going for $115 per month with trading signals included. Find the link in the description box below and join the winners. Welcome to Bunnex Investment Group. In this video, we are going to talk about a top-down analysis that will definitely make some changes in your trading. Without further ado, let's jump into the video. So what is top-down analysis? Basically, we have several time frames. You can see starting from 12 months down to 1 second. Basically, what these time frames are for is to actually give us a picture. We say whatever is happening on the higher time frame, it is built on the lower time frames. Therefore, what you should do is to actually know where the market is going to move next within the higher time frames so that you understand what you are looking for on the lower time frames. So basically, we are not going to delve deep into very high time frames, but we are just going to use our daily time frame as our initial time frame of analysis. So whenever you are given any tradable asset, you can actually start from the daily time frame. So what do we look for on the daily time frame? On this particular channel, we actually use what we call the institutional market maker method, which we also teach. On the institutional market maker method, the first thing is to always start on the higher time frames, and then after that, we need to actually look at the cycles. A cycle is basically a movement of 3 impulses in one particular direction. So to simplify the concept for those who are not well versed with it, we say we look to make a reversal after every 3 impulses in one particular direction. An impulse is basically a fast move in a particular direction, followed by a corrective structure, another fast move, another corrective structure, another fast move. To simplify further, we can simply say an impulse is validated after break of structure twice. In this particular case, we can see there was break of market structure at this particular point, meaning that there was a break of this high, and then there was another break of this high. When we break structure twice, we look to get a market reversal or a market peak formation high or peak formation low, depending on the market context. In this particular case, after twice the break of market structure, we can see that at this top part, we had an M pattern, which is now confirming that we have reversed or we have completed that particular cycle. From there, we can now see that the market also broke structure twice. There was this point that was broken. Then there was this point that was also broken. So there was twice break of market structure. After break of market structure twice, we look to find what we call a reversal. A reversal was issued. So basically, that is what you will be looking for. You need to look for break of market structure twice, and then you look to get a market reversal. So in this particular case, we can see there was a reversal that occurred, and there was a long ride of gold to the upside like that. This long ride had its break of market structures. We can see there was this point that was broken, and then we had this point that was also broken, meaning that we are at a probable point of reversal on the higher time frame. We've said when we complete a market cycle, we look to get an M pattern, which we also term a peak formation high or a peak formation low. With that in mind, on the daily time frame, we now see that we have a move towards the first leg level like that. Meaning that if we go on the lower time frames, our bias in this particular case is going to be up, and then later will be down. So on the lower time frames, we are now shifting to the H4 time frame to see what is taking place on that particular time frame. We've said we need to reach this zone for us to look for shorts, but in that particular movement to that zone, we can actually utilize the move and get buys, right? Whilst we are still on that, we can see that the market created this low whilst it was coming from the first leg level on the daily time frame. And within that, we can see first break of structure that has been issued, and then we are waiting for this break of structure that is going to be issued. Therefore, if we see something like this, whereby we can see the market breaking the market structure, and then we will be expecting to get a lower time frame entry. From the H4 time frame, we now go to the H1 time frame. What is happening on the H1 time frame? On the H1 time frame, we can see that there was a move to the downside, but the ultimate move is to go to the upside. Therefore, how were we going to get this particular move? It means we now need to incorporate the M15 time frame. On the M15 time frame, was there twice break of market structure? We can see that there was this break of market structure, this break of market structure, and what do we get? A peak formation low. Therefore, we could have made a buy at this particular zone. This was supposed to be the trade that we were going to make earlier today. So basically, that is how we use the top-down analysis to get pristine points of market entry. On that note, we've come to the end of our today's video. I'll see you again in the next one.